Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 119th VideoCast, 109th podcast for the week ending January 28th, 2022. What a wild week, to put it mildly, but I waited till the end of the week, until the end of the session today, because I wanted to see how we could finish the week with some strength. And we'll go into a lot more, but what's most interesting is here were the sectors today. I want you guys to take a look at this, and gals. Tech was the top performer, followed by biotech, up 3.47%, followed by the NASDAQ, up 3.14%. The worst performers were energy and banks. So we've been saying that was going to happen for the last few weeks. It's starting to happen. When everyone wants it, help them out. We've taken down our energy and banks materially in the last few weeks in order to fund our new big position in biotech. And we white knuckle added a lot of biotech this week, and this morning in particular. It was like, oh, but it was that exact same feeling. I'll never forget going into the 2016 election. The market just kept dropping and dropping and dropping into the election. And we kept buying small cap Russell 2000 IWM call options, and just kept buying it and buying and buying them. And as soon as the election was done and the uncertainty was in the rearview mirror, those things went up. It was one of the best trades ever. So that's how I felt buying biotech this morning. But it's been incredible, and I think that's going to be a home run here. So we'll talk about that in greater detail. But this was just huge, because everything that everyone was saying about what should happen from the Fed's hawkishness, the exact opposite happened. The old saying, the market is designed to fool most of the people most of the time. And I could just see it. All of the people that you hear from that now love energy and banks, they were the same ones when we were talking about them in 2020 and pounding the table. They were the same ones saying, you're crazy to buy banks, you're crazy to buy energy, we don't need those anymore, et cetera, et cetera, et cetera. Tell the Europeans, why don't they run their, why are they so worried about their natural gas? Why don't they just run on windmills and solar panels? I mean, what's the problem? So we'll talk a little bit about that, and that goes in line with, it's going to be a long transition, and yes, we make incremental steps, and it's good to do that. But it's naive to think that you're not going to use fossil fuels for the next 10 or 20 years, and there's money to be made. That said, that's now starting to get priced in, and we're going to talk a lot about how to make money in the business is fishing where other people aren't. And when they all come over because they see you catching a lot of fish, it's time to cut bait, pull up anchor, and move to the next area where no one is. And we're going to talk about what we've been doing in that context in the last 5 or 6 sessions. So first off, let's do the media spots real quick. I'd like to thank Ellie Terrett and Liz Clayman for having me on the Clayman Countdown on Tuesday. We're going to go into that in detail because I made a pretty bold call there. And Liz was like, you sure you're putting yourself out there? I'm like, yes. And it's worked out so far. So the key thing that I said was it was Tuesday afternoon. The market was kind of moderate. It was vacillating between up and down. And I said that, you're not going to get a 20% correction in the S&P without a recession. You're not going to get a recession without a yield curve inversion. We've been flattening, but we're not close to a yield curve inversion. And then I talked about the washout. I said yesterday, which was Monday, we had a put-call ratio at 1.26. Everyone was buying insurance while the house was on fire at the exact wrong time. The time to buy insurance is when there's no fire in sight and everything is calm. The VIX had gone up to 38. And the AAII sentiment survey was down to 21% bullish. I said those are 3 indicators of market inflections. I think the vast majority of the pain is in the rearview mirror at this point. And she said, "Wow, Tom just put himself out there." Well, we've held the line, and that was a good thing. So here's the week. That was Monday. That was Tuesday on the Clayman Countdown. We held those lows from Monday. We said that the major pain was in the rearview mirror, and now we're taking off into the close, which is really, really exciting. to see how the market closed this week. So again, thanks to Liz and Ellie for having me on Monday. We'll talk in more detail about that in particular as we get to the article of the week. Want to thank Taylor Clothier for having me on Yahoo Finance with Alexis Christoforous, with Adam Shapiro, Karina Mitchell. Also want to thank Sarah Drammer, who helped produce the segment. I appreciate you guys having me on. We'll talk about that segment in the article of the week. Then that was on Wednesday. I was on Yahoo. Also Tuesday night after the Clayman Countdown, I was on CGTN America with Rochelle Akufo. I want to thank Rochelle and I Zing for having me on. I is the producer. And we talked about the Activision Blizzard deal with Microsoft and Microsoft earnings. Also want to thank Akshay Chinchalkar and Abhishek Vishnoy for including me in their article on Bloomberg this week. The trading, and again, I was calling, a short-term bottom on Monday, saying that the trading session on Monday had a feel of short-term capitulation, said Thomas Hayes. The key signals for a tradable bottom to be confirmed will come from earnings of technology companies. I had said in the email, IBM's were strong; they beat on revenue big time, and then Microsoft. We needed to see, as well as Apple, which we did, and I think we've put in the short-term bottom here. And some market-friendly Federal Reserve guidance on balance sheet reduction was the other thing we would need. That's the other thing I said on Liz. Is I said, Liz, the pain is in the rearview mirror, but we need to see two things: a continuation of strong tech earnings. Microsoft reports tonight. That's critical. Those turned out to be great, thank God. And the second thing is a bit of a walk back on the balance sheet quantitative tightening, which we did get on Thursday, and we're going to go into detail in the article of the week. So the same thing with Bloomberg. Reuters want to thank Bansari Kamdar and Devik Jain for including me in their article yesterday. And I guess this was before quantitative tightening. The market has priced in the rate hikes, but they've not completely priced in quantitative tightening because we don't know what it's going to be and we don't know the impact. So that was before the Fed meeting, if I recall correctly. Yeah, that was in the morning. And then earlier in the week, we were talking about, it was the anniversary of the meme trade. I said, as rates rise, the present value of future cash flows diminishes, and it takes some of the speculation out of the market. So there was a period where there was all this free stimulus money and low rates and margin availability, and that's coming to an end. It's interesting. Lydia Moynihan over at the Post did an article this week. You should check it out. Just Google New York Post Lydia Moynihan about how all of these young folks who were home with stimulus checks and Robinhood accounts that were gambling on meme stocks, knowing the price of everything and the value of nothing, they're now moving. They're finding there was some data that they're all moving to gambling sites now that sports are back. So, the mentality has stayed the same, and that's probably a good thing. That probably have better odds gambling on football games than gambling on stocks that they don't do research on. Now, that's not to say, and that's not a criticism, because everyone comes into the business not knowing anything, making mistakes, blowing up a few accounts, personal accounts, and then learning the game over time. That's a good thing. And the 10% or so that get the bug and learn how to do it properly and do proper research and know what they own and do the work and not try to get rich overnight, they'll become our next generation of portfolio managers and leaders in the industry. So it is a very positive thing when you get those swells. But the ones that are, for them, it could be, betting on the Jets or betting on GME, it's probably better they bet on the Jets. They probably know more about the players and they probably take more interest than just, hoping for the best. Okay, now let's move on to the questions of the week. Ask Me Anything questions. We got a ton of them. First off, from Brady Todaro. Tom, 2 questions. I'm a shareholder in Starbucks. With the unionizing of a few stores recently, will this hurt them in the long run if it continues to spread? Raising wages and benefits, etc., while dealing with inflation. Chipotle raised prices to pay its workers more, and its consumers seem to agree with this. I'm not sure how much people will tolerate raising coffee prices when they realize they can save money by buying coffee at the grocery store and making it at home, or finding another local coffee shop if they raise their prices to deal with their workers unionizing and demanding more from them. I feel the image Starbucks has been trying to promote has only attracted that type of worker, which has led to its workers pushing Starbucks to become more and more progressive when in reality they just make coffee. I worked at UPS from 2011 to 2012, and they told me 55 cents of every dollar went to labor. I'd be curious to see in future earnings report how much Starbucks spends on labor and other benefits because of its unionized stores, and if workers will go on strike when negotiating contracts break down when all people want is their coffee. Okay, then secondly, he says, will Visa, MasterCard, and American Express, I own shares of AXP, struggle in the future because if businesses stop accepting their cards, they don't have to pay merchant processing fees. This is their main source of revenue, and other fintech companies could produce a card that doesn't charge to process the payment, functioning like a debit card and or pay with cryptocurrency. Would love the podcast. I listen to it every week and read your newsletter. Thank you for that, Brady. Your advice has helped me minimize my losses and build wealth. Thank you so much, Brady Todaro. Well, thank you. That's very kind of you to say. I put a lot of effort into this, and it's nice to get the feedback. I appreciate that. So as far as it goes with Starbucks, the key thing here is that someone sent me a question about companies trying to be woke or something like that. I mean, look, the bottom line is Starbucks is not going to destroy their business to appear progressive or to appear like they're pro-union, because they're not. It's a money-making business. They answer to shareholders. If you look at Nike, which is a very woke company and progressive company, that's marketing. That's really what it comes down to, because you got to just think about where do their sneakers come from. If they were really progressive and they were really woke, they would have people in the U.S. Manufacturing the sneakers at high wages in union shops, and they would just take less profits because it's better to spread the wealth all around. But they don't do that. Instead, they spend millions of dollars on commercials to pretend that that's their image because it resonates well and it sells more sneakers. So as far as Starbucks goes, they have a certain image that they project and the public likes it, and that's what they're going to continue to do. But, I traveled to Key West this last week, and you walk into the, you asked about American Express. You walk into the American Express Centurion Lounge at LaGuardia. There are these two fancy machines on the counter by the bar, and you walk up to it, and it says, cafe latte with oat milk, cafe latte with dairy milk, espresso, cappuccino decaf, cappuccino super cappuccino, espresso, blah, blah, blah. And you just push a button and it comes out in the cup, and it's fancy and it's high quality. So the more stores that unionize, the more of those type of machines are going to be there, and there'll be one person behind the counter, and they'll just press a button and it will go. The purpose of unions, which do serve a purpose, was for skilled labor who spent 10 years in an apprenticeship to learn a skilled task, whether it's pipe fitting or electricians or certain high-value construction, HVAC, these specialized skills that take a long time to learn, that you work in an apprenticeship so that when you finally have the skill, your wages are protected. Otherwise, the employers would just say, well, they're screwed. They can't go to work anywhere else. We'll just pay them whatever we want. And that collective bargaining for skilled, specialized labor, does make a lot of sense, because if you devote that much time to develop a skill, on the one hand, it'll be partially scarce in the market, so you'll be able to command the value that you deserve with or without a union. But on the other hand, that certainly makes sense. And to some degree, it made sense in the early days of the assembly line with automobiles when it was more skilled. Now it's more automated. But, you see Tesla is doing just fine. They just, rather than unionize, they just pay their workers above market rate, and they seem to be doing just fine that way. So I think what you'll find with Starbucks, as much as they want to project a certain image, they are a business and they do answer to owners. And what you'll find is they'll either it will lead to more automation. So the net effect will not be that workers will get higher wages. The net effect will be that there will be a lot less workers. So it will force them to automate more quickly if more and more stores drop. The other thing that they'll do if it gets out of control is stores that organize, they'll just shut them down. And then the next store will think twice before they organize. But that is in the context. I mean, look, at the end of the day, there has to be fairness. So it's not like unions are good or bad or whatever. And it's my understanding that Starbucks does pay well above average. It's my understanding that for entry-level workers, they can apply to get free college paid for, online college to get a degree while they work. So I think Starbucks has really gone out of their way, at least they've projected, to pay workers well above average and to provide them ancillary benefits like healthcare and different things that you don't normally see in entry-level jobs. And so if there is unionization, I would say the electricians and the plumbers and the specialized construction workers and the cement layers and all of these people that have specialized skills, they're always going to be successful. They probably should have unions, and it's worked well, and they should be paid for investing that amount of time. But if I can go into Starbucks and learn the job in 6 hours, how to make 18 different types of coffees and call them fancy names and double charge, I don't have that much value add other than my smile and being friendly and having a good attitude. And in that context, the idea of like organizing, there's no incentive for the store to negotiate, for the company to negotiate with that in a material way. They'll just shut down that unit, and then they'll just shut down units and until they can come to some type of agreement. Like, we're not willing to unionize on a widespread basis, but we are willing to obviously address increasing labor costs and cost of living with regard to inflation, come up with some fair agreement that makes sense for all parties interested. And then the workers will have a choice. I mean, in a market where there's 10.5 million job openings, the workers are really in control with or without a union. They can say, look, I provide XYZ value. If you don't pay me $25 an hour or whatever they're demanding, $30 an hour, I'll just go next door because there's 6 help wanted signs down the street. So I do think workers have the leverage in terms of asking for pay raises, and they'll probably get them. I'm not sure outside of specialized labor, and even like teachers have specialized labor, they're successful in having their unions because they, again, invest 5 or 10 years to develop the skill, and there's a lot of value add. In those type of specialized areas, unions can work. But in a type of, business or job where you can go in 6 or 12 hours, learn the business, from A to Z, it's, very easily replaceable. Players unions work because, you invest your whole life to a particular sport, to a particular skill. You add a tremendous amount of value. Again, that's another area where unions work. So it's not anti-union. It's discerning the justified value for unionizing for a particular skill set versus, the overriding idea. So I hope that comes across. The point is, it's not going to be a problem for Starbucks. It's a nice headline in the short term. Amazon's dealing with it a little bit, but they'll get it done. They're just going to raise wages and it'll be fine. And if it becomes too organized, they'll just shut down a bunch of places, and then workers that like working there, that don't want to take their skills somewhere else and get more money elsewhere, will probably say, look, let's just come to a reasonable agreement with them without unionizing, because they seem to be shutting down all the stores that are unionizing. And I don't think it'll get to that. I think people are just going to pay up for labor because it makes sense. Okay, Visa, American Express, MasterCard. Look, that was the same reason they were telling us not to buy banks in 2020, because DeFi was going to take over the world, and who needs all these branches and et cetera. Things take a long time to change. I mean, look at the real estate brokers. They're making 6%, 100 years later. It makes zero sense in theory, but in reality, that structure is in place. People accept it, and therefore it persists. Many people have tried to do online real estate brokerage. It hasn't succeeded yet. Maybe, the Jeff Bezos of real estate brokerage will come in and figure out a way to do it with smart contracts. But again, it's not going to change overnight because it's embedded. And the same is the case with American Express, Visa, and MasterCard. So it's not something you have to think about on a 5-year time horizon or a 3-year time horizon, but it could evolve, and you keep your eye on. Nothing is set and forget in life. You got to keep your eye on everything. But you saw American Express's earnings. They're on top of it. As far as MasterCard, I have a friend who works there. They are, they're not asleep at the wheel. Let's just put it that way. So thank you for that. Next, Ben, first name only. Tom, you mentioned something a while ago regarding registering BABA differently with one's broker. Does this apply to simply buying BABA through an online broker? Yeah, I mean, you can either, we own the Hong Kong shares 9988. So we originally bought BABA. By the way, Munger owns BABA, so it's not going to be a big issue. There was a legislation proposed in Congress this week that put a little pressure on the shares about moving it from 3-year timeline to 2-year timeline if they don't comply. So that's why I didn't want to think about that anymore. So I just switched them out to Hong Kong shares. It was 8 for 1. I can always switch it back. It's a small transaction fee to do it. It has no impact on valuation, but I don't have to worry about the possibility of delisting. And even if you own the BABA and it got delisted tomorrow, they'd probably give you the Hong Kong shares anyway. So not a big deal, but you could do it with Interactive Brokers. You can probably do it with most brokers. Depending on the brokerage, you'll either get the Hong Kong shares if they can do the currency, which would be 9988, or you'll get a placeholder. I think it's BABAF is the Hong Kong placeholder, which is also fungible and can be transferred for shares. 2, has BABA bottomed, or might 108.70 not hold? I think it's bottomed. I think it retested this week on that week news. There was 2 things this week that put pressure on China stocks. One was there were rumors on the trading desk, which I think are unfounded, that SoftBank is blowing up because what's his name, Sergio Marcion or something, like the guy who ran Sprint, is leaving and he wants $1 billion, and Masayoshi-san has a 25% position in Alibaba. It's their biggest position, so there's fear that all of their venture investments are going bad, and therefore they'll have to sell Alibaba to get liquidity. And there was, structural issues. And I think, by the way, there were structural issues throughout the market this month as far as tech. All the people that were overweight these high multiple no earning stocks in the last 4 weeks had to unwind, and people who had leverage to crypto had to unwind. So there were probably a lot of blow-ups. That's why you saw the volatility. I think that's coming to a head here. I think that's largely in the rearview mirror. And nothing changed fundamentally. I mean, look, all I want to know is, what was their return on invested capital last year, the year before, the year before that, the year before that, and the year before that? And if it's above market return on capital, and they're compounding at 15 to 20% every single year, so they've got COVID last year, maybe it went down to 15%. That's the type of business I want to be in, above average. And by the way, if you can buy that, which you rarely can you ever buy a business that's compounding capital over 15% a year at a below market multiple. And here you could buy it at 13, 14 times next year's, and much lower multiple than that a couple years out, maybe high single digits if you look at a couple years out estimates. With continued top line growth, it goes down from 30 to 20. Earnings, goes from 20 to 15. But, they've got a moat. They're expanding internationally. So, does it go to 107 before it goes to 200 and 280? I don't know. Don't care. I don't think so, but, it is what it is. Possible catalyst for BABA to move higher. I think you're seeing it already. We're going to cover a lot of the stimulus that the Chinese government. Look, the number one stimulus is trend. Opinion follows trend. So the government is now realizing they went too far, and they are literally throwing the kitchen sink in terms of stimulus. They're now basically telling the portfolio managers in the country, basically, we effed everything up. If you don't buy the stocks, we're going to, take you out back behind the barn and kill you. So all the mutual fund managers now have to buy the stocks that they destroyed with their overzealous regulation and heavy hand. But it is what it is. I mean, this happens every 3 to 4 years. It's painful in the short term. It creates an unbelievable opportunity, and you just got to sit through. And we'll cover some of that this week in terms of under the surface. When you got the fish hooked, that fish doesn't want to come up to the boat, and no one's going to give you free money. They're gonna give you some white hairs before they let you make a multi-bagger. And that's just the way the world works. Otherwise, everyone would be, super wealthy. And the fact of the matter is, most people get spooked because they don't know what they own, and they're impatient. They try to get rich overnight, or they haven't done the homework. If you've listened long enough, you're not in that camp, or my message wouldn't appeal to you. Buy high quality when it's on sale. Be patient. Ignore the short-term noise, and double your money. And then when everyone wants it, lay it off. And go back and do it again and find out what no one wants and what everyone's down on. That's high quality. That's compounding capital. Buy it when no one wants it. When they all come, help them out. Give them what they want. Do it again. That's, it's not rocket science. This business, there's probably an inverse correlation with IQ when you get above 145 or 140. The folks you see at 150, 160, they tend to do horribly because they have no kind of emotional fortitude and thoughtfulness, and I'm sure there are exceptions, but nonetheless, good questions here, Ben. All right. Last week you shared the size of your position in biotech. Please share your current BABA. BABA, we got up to close to 20%, and biotech is now close to 20%, if not at 20%. We added a bunch this morning. So those are, super high conviction. We have sector risk with biotech, but we don't have single stock risk. It's a very large basket and of stock and embedded derivatives. So it will really be it's broad exposure, and it's very constructive, and we feel very good about it. And we're very happy that it was one of the top performers of the day. So the tide may be turning, but one day doesn't make a market. So we'll take it as it comes. We likely won't be adding a lot more if we get further weakness. We'll just ride it out. That's a very strong position. So, okay, when is the Build Back Better legislation scheduled to be voted on? It's not. I mean, it basically blew up. If you look at this article, they're going to try to pass it in different smaller chunks. But it's unlikely in an election year when they need to raise money to get reelected, which is their number one job, that they're going to be screwing the pharma companies that give them money to get reelected. So the end line here was from Manchin. He said, we'll just be starting from scratch wherever we start. So here we are. To 9 months away from the election, and they're going to start from scratch on the Build Back Better. I mean, low probability of them getting anything materially significant done. But they may get a couple of small things here and there that would make sense that people can agree on. But, with inflation numbers backward looking as they are, they're very worried about inflation going into the election, which they should be, and passing something out of the ordinary or excessive would, at this point, hurt their chances of re-election because the market will start to anticipate higher inflation, and expectations are the name of the game when it comes to inflation, and they don't want that going into the election. So, maybe a few $100 billion there, a few $100 billion here, there, etc. But I doubt they do anything material with the drug things. I think that now is the time. The key reason that biotech was down was the same reason that tech is down, and it's close to one and the same here, and that is because the fear of interest rates. But when you actually go back and look at the data quantitatively, it's not a foregone conclusion that every tech stock does poorly, or every biotech stock does poorly, or emerging markets for that matter do poorly just because interest rates go up. And in the first 12 months, towards the latter half, potentially there's a heavier weight as rates really start to move up. But coming up off of zero, you go up 100 basis points, it's not going to have as material of an impact, particularly for companies earning money. Those that are earning nothing, they've been taken out to the woodshed and shot. So, and rightfully so in the short term. Some of them will prove to be great businesses down the road, but it's just not the right timing for them. So good question on that. And then, do you have another one, Ben? Oh, what's the latest on the Iran deal and the likely effect on oil prices? Well, yeah, look, people want to get reelected. Having high inflation, inflation is directly correlated with consumer sentiment. As long as inflation is not coming down, consumer sentiment is going to be in the toilet. If consumer sentiment is in the toilet, you're not getting reelected. So they got to bring oil down as fast as possible, and it looks like they're going to do that. This is from the Times of Israel from today. It says, U.S. and Iran, quote, in ballpark of possible nuclear deal, says White House official. So yeah, we've taken off a meaningful amount of our energy, not because we think it's going down tomorrow, but because we think that there are other areas that are unfished, that there are a lot of prize fish still left, and we think that we'll get a much quicker, larger return on our money in a shorter period of time. And then in the meantime, we'll have some of our core positions still in place for energy and banks. If we get a real pullback in those groups sometime this year, we'll add back with a three-year outlook. And if not, we'll be perfectly happy with the moves that we made off of 2020, banked them, and on to the next. So great questions, very thoughtful, and obvious to everyone that you've been studying and listening to a lot of this. Okay. Let's see. I think he sent me multiple emails. Okay, Ben, again, another podcast question. Your excellent Thursday website sentiment article included the following regarding two reasons that the IBB-XBI have underperformed: overhanging drug pricing with the BBB legislation unlikely to pass, as well as reduced demand from lower doctor and hospital visits during COVID. Two questions: when is the BBB legislation scheduled to be voted on? We just covered that. Two, many non-stream media sources have stated that the negative reactions to the vaccines are very dramatically understated. Of course, the benefits of the vaccines still substantially outweigh the risks. These adverse reactions could cause a continuation of the lower doctor hospital visits for typical maladies in the above quote, but won't these unfortunate adverse reactions sadly also require pharmaceutical drugs sold by the biotech companies? I think you're overthinking this. I mean, the bottom line is just go to an airport. It's filled. People want to do stuff. They're over it. Everyone's either boosted by now or they've had Omicron and they have some level of immunity and they're happy with that, and it's on to the next. I mean, they tried to throw a headline out, a new variant. No one cares anymore. Like, it's yesterday's news. The cases have rolled over. No one cares. No one talks about it. On to the next. All right. So a couple other questions. Tom, I want to thank you for your videos. I watch you every week. My question is, what are your thoughts on Teva, which is it's not a biotech. Well, it's a generic producer. And CXW and GEO, the prison centers, these are all trading near 52-week lows, and earnings are about the same year over year. Thank you, Antonio. Yeah, you want to look at forward earnings. I mean, the prison things are fine. They thought they were going to cancel them once Biden came in. He promised to cancel them. He hasn't canceled them. They're probably okay. It'll take a few years for them to continue to recover. but you'll probably be okay there. Teva got a bad ruling on their opioid liability, so that's going to be in the doghouse for a little longer. But I think over the intermediate term, that's something you can accumulate and manage your risk by size, because you can't predict what the courts are going to do per se, but they'll find a way through it, and I think that's going to be probably a multi-bagger, but that's going to be a 3 to 5 year story. Thanks for the video, Tom. Look forward to seeing biotech. Okay. Thanks for a great video cast again. I would like to start a portfolio for my kids. Boy 1 year old, girl 5 years old, so at least 15 to 20 years before they get it. I'd like to know your opinion on what's the smartest to invest in. For example, a single ETF or multiple ETFs, stock or combination. As it's a long position, I don't really want to buy and trade a lot, just buy and hold. Yeah, and you probably want to do that for tax benefits. Look, you could do two things. The Buffett strategy is the easiest. Just buy a total market ETF. You could get the Vanguard VTI is a good one. Vanguard Total Index VTI. It's a low-cost way. You get broader exposure to the market, or you can just get the one that tracks the S&P 500, SPY. So he suggests to his family 90% in that, 10% in treasuries, just in case, something crazy happens. You have some cash to weather through in the short term until it recovers. So that would be, with a 15 to 20 year horizon, I wouldn't have a horrible time talking about that. If you want something a little bit more volatility dampening with lower returns, you could do like 20% international ETF, like IXUS or VXUS, 20% in the US, which would be like VTI or SPY. You could do 10% emerging markets, EEM, or I think VWO. 20% in REITs, which would be your alternative exposure and partial inflation hedge. IYR or VNQ, I think, are two options there. And then volatility dampeners, you would pair like TLT and TIP. So Treasury inflation protected securities with long bonds. Long bonds give you appreciate when you have market crashes, so that'll give you cash to put to work in equities when market crashes. TIPS will hedge you against inflation. The bottom line is you don't think about any one of them in isolation, because no one would buy long bonds with rates so low, but you would buy them as a volatility damper. But it's going to be a drag on returns just so you sleep better at night. But you could do 1, 2, 3, 4, 5. So that's 6 ETFs and just set it and forget it, or rebalance once a year if you're in a non-taxable account. Again, this is opinion, not advice. So go to hedgefundtips.com, click on terms. But I think Buffett's way with that type of time horizon, 90% in a VTI and 10% in cash or bonds, treasuries, is probably a reasonable way to go, because you're going to get the compounding and you're owning 500 of the best businesses in the world. So that's for Kashganja or Bart in Belgium. Thanks. Wow, Belgium. Cool. Okay, Sam Swisher here. Hey, Tom, not sure if this is where I'm supposed to ask me anything questions, but here it is. I was wondering if there was anywhere in particular you look to find solid stocks that are cheap, any specific lists, indexes, websites, sectors. I don't want you to tell me which individual stocks to buy. I need to learn from my own failure, success, and stay disciplined. If the reason people invest is to make... okay. So, one thing I suggest to all new entrants into the market, read every Warren Buffett annual letter. Go to berkshirehathaway.com. They're free. And then read Intelligent Investor by Ben Graham. And then as far as you got to learn the stocks. There's no sense in having a list of cheap stocks. You can find, lists from people who are not qualified to give lists any day of the week on the internet. But what I do suggest is go to your library, and they probably have an online subscription you can use, or they have the old Value Line investor surveys. They cover about 2,000 of the largest companies in America, and they have a one-pager on each company, and every day just learn 5 new companies. That's it. And within a year, you'll know basically all 2,000 companies in a small way. And then you'll just learn more and more as you learn more, and you'll see how they evaluate them. You'll see what's quote unquote cheap. You'll be able to see how they compound or lose money for shareholders. You'll see if they expand the share count or contract it by doing buybacks. But I would start there. That's the best way to learn it. And that's what Warren Buffett did. Back in his day, it was Moody sheets. But if you see pictures of nowadays, you'll see the value line binders behind him. He still goes through the value lines all the time. It's simple, but it works. And that would be my greatest suggestion. I think that is the record by 3 times on the most number of questions we've ever gotten, Ask Me Anything questions. But the feedback I'm getting from everyone is that you learn probably more from the questions than from me flapping my gums, or at least you like the questions. So that's a good thing. All right, let's go through a lot of stuff this week because it's been a pretty wild week. This is from Sarah Ponzek. She used to work at Bloomberg. The average S&P bull market correction has been 14% throughout history. Over the next 10 months, the index average gains of 17.7% and was negative in only one circumstance. So that's the data there. Average over the next 3 months, 7.5. Next 6 months, 12.5. Next 12 months, 17.5. Which that makes perfect sense. That would put us right at our target for the end of the year, which has been high single digits to low double digits since last year. We've been talking about it every week. Ryan Dietrich at LPL, should we fear 4 or 5 Fed hikes? Here's all the years that had that many or more and what happened next. So the years that had these hikes, on average, in years that you had, well, yeah, this is not the best data source because he's got 1973 and 1974. There were 16 hikes in 1973 and 16 hikes in 1974, and those were the 2 big down years in this data. But still, on average, the market was up to 3.5%. I would say if you probably backed it out to those years that only had 4 hikes, and we'll be lucky if we get 4 hikes because I think inflation will start coming down by the summertime. Your average is probably double digits, actually. If you look here, 10%, 31%, 1.4%, 12.4%, 13.6%, and one negative 6.2. Yeah, you're probably over double digits for the years that had 4 hikes. So that would have been a better sample there. Ryan puts out another one. Stocks are nearing a correction. This isn't fun. Well, they did correct 12% intraday on Monday. I think they're down. Well, now that's probably only 7% on the year. But it's part of the process. Here's a list of what other corrections since 1980 up a year later. Up 25% on average and higher 90% of the time. 2 years out, it gets even better. So he did all the corrections since 1980. The average was 18.8. 1 year off the lows, on average up 28% off the lows. But if you're down 18 on average, so, net 6 or whatever it is, and then 2 years after up 37%. So it just kind of shows you it's just a normal part of bull markets. Macro Charts put this out, investor sentiment at historic pessimism. We covered this in our weekly thing on the AAII sentiment, but he goes a step further. He says, even in 2008, similar spikes led to violent bear market rallies. And lastly, when investors got this negative, the tech crash was over. So you'll see all these green dots, and you can see how the S&P responded, and that's where sentiment is right now. And we covered that in the last article that that individual investor sentiment was completely flushed out. The other thing you hear is, margin debt is at all-time highs. Not if you actually measure it properly, which would be against the value of the index. So in absolute terms, if I say, car prices are crazy, but I don't adjust them for inflation, I don't really have a good metric. And here, if you measure it against the indices, we're nowhere near the highs before the great financial crisis, and people have delevered quite a bit. Margin debt is a percentage of the Wilshire 500, so PROFPLUM99 put that out on Twitter. Macro Charts put another one out, which I think this is focused on tech. NASDAQ investor sentiment is worse now than it was in March of 2020. That was the bottom that we called in Market Watch The article you can see on our website. I think our article was on March 19th or something, and the market bottomed the next day, which was pretty damn close, close enough for government work. And it said that's an extremely aggressive bearish posture. Bearishness has fallen to such an extreme that it supports a significant stock market rally. And it shows the level of sentiment, how low it got, and it hasn't. It's lower than where it was at the pandemic. That's mind-boggling. So I think we saw the first recovery leg today on that basis. General market stuff. This is key. After 3 weeks of absence, stock buybacks are back. There's over $1.2 trillion of stock buybacks, and as companies report and their blackout period unwinds, they're going to be, U.S. corporates are the largest buyer of equity market in 2020 with $975 billion of demand, the best year on record. This is roughly $245 billion per quarter. Next blackout is March 14th, so they're going to be back in the market. This is between now and March 14th. This is $5.5 billion per day during this stretch. 8% of the S&P is currently in the open window. This matters for the index level as much as not being in the market also mattered. So expect the buyback money to start to flow back in. And this is really good research from Goldman via Zero Hedge. So thanks for putting that out to Tyler. Okay, the market in stocks. This is very interesting. This came from Ned Davis through Business Insider. And we put out a lot of these indicators every day, and you guys can look at them or not look at them, but we find them helpful when you look at all of them together. No one is a magic bullet, but they all help in concert. So the bull market in stocks will have a new lease on life if this technical indicator flashes, research firm says. January decline in stocks has bulls on notice as volatility surges and several technical support levels are broken. Ned Davis suggests investors monitor momentum to gauge if stocks will recover. Another round of breath thrust would signal the cyclical bull has a new lease on life. So what is a breath thrust? I pulled up the NASDAQ version of the breath thrust. And what you're going to see here, the most important thing you need to understand is what happens on average when it gets this negative. So we're at negative 55 here. The last time it only got down to negative 42 during the pandemic. So that just shows you the level of negativity and panic selling and blow-ups and that type of thing. Last time it did it before that was right here in December of 2018, the last time that Powell blew up the market, and monster rally after that. The last time before that was 2016. You had a couple more weeks, but on balance, you were at the bottom. The crash had already happened, and then you recovered those high in a few months, et cetera, et cetera. So this looks good on that level. I think we're here, and I guess if this updates, you'll see that this red turned black. I don't know if I think they wait till 6 o'clock to update it. All right, same thing with the New York Stock Exchange. We'll take a look at that. NYSE breath thrust. It's down at negative 55. During the pandemic, it got to negative 53. A few more days, and then it just took off. Same thing in 2018. It's right here, literally at the lows. 2015 at negative 60. It had crashed. It took a few more weeks, then it made new highs. And then what was this? This was May 2012, again right at the low, and then it took off. So this is a good indicator. It looks like it's at an extreme. We covered that last week, all the NASDAQ ones that were at extreme, and they've started to turn. Here's another one from today. Again, lower than right at the levels of the pandemic low, and it just ripped from there. So this is the NASDAQ cumulative volume ratio 10-day average. So everything's pointing in the right direction, and today confirmed it, which is why I waited till the close to start the podcast VideoCast. Some biotech news. Biogen sells stake in biosimilars venture to Samsung Biologics for $2.3 billion. We're going to start to see more and more deals in the biotech, and that's going to help ramp up the space. That's going to be a key catalyst moving forward. The companies that have been stale, they're going to start doing deals. They're going to buy others. buy their stock, do spin outs. They're going to create value because shareholders are going to demand it. This came from today. Boeing might be making a new plane. That would be really good news. That's from Al Root over at Barron's. We'll see if that rumor proves to be true. Stock's been weak on the earnings because they had a $5.5 billion charge on the 787 delays, but they did turn free cash flow positive for the first time since early 2019, and they increased production of the 737 MAX to 26 jets a month. They also announced this week an order for 4 777 freighters from China Airlines. So that is a big olive branch. I'm sure the Chinese government wouldn't allow that if we weren't moving in that direction, and more importantly, if they didn't need them. And that implies that the management promises that the 737 MAX would be up in the air by the end of this month, or now very soon. That should happen. Once that happens, I think the orders are going to pour in, and I think the stock is going to finally rip. But it's been, it's been like watching paint dry. But I think we'll get a turn here shortly. At least we know what the catalysts are, and that's that. Moving on to China, all of the expected easing into the China National Congress is now starting to happen. Has been happening since November and is now accelerating. They're throwing the kitchen sink at it, as I said earlier. PBOC gives clear easing signal with promise to boost growth. Central bank to roll out policies to stabilize economy. Room for RRR cuts. Reserve requirement ratio cut has narrowed. Debt ratio to be stable. Bank of China, People's Bank of China will open the monetary policy toolbox wider, maintain stable overall money supply, and avoid a collapse in credit. Deputy Governor Liu Zhaoqing said on Tuesday at a briefing in Beijing. So they're going to do whatever it takes. I mean, the last thing Xi Jinping wants to do is go into a transition meeting with the economy in the toilet, unemployment, and protests on the street. That wouldn't work. So they're literally, they overstepped last year. They had to bring some of these companies in line, but they went over the top. Now they got to rein it back. And this happens every 3 to 5 years, and it's nothing new. So China urges banks to boost lending after slow start to 2022. So they want to increase credit. They're doing everything. PBOC issued window guidance this month. Central bank is loosening monetary policy, diverging with the Fed, which is why we think it's going to be one of the best trades of the year. While the rest of the world is tightening, they'll be easing. And that story hasn't changed. So Pledge to Open Toolbox puts focus on less known options. So they're going to be using deposit rates, FX purchases seen as potential options, structural tools, window guidance could lead to more lending. And they started that last year with $183 billion to small businesses. I'm sure they're just going to open the spigots, and they're going to open them quickly. China urges banks to boost property lending on default fears. So they're winding down the Everbank, which we talked about months ago, that they'd break it up into multiple parts and nationalize some of them. They're doing that. China's seen cutting rates once more before July, analysts say. Okay, so more and more. China stocks glimpse light at the end of the tunnel. China's central bank is tilting dovish as Fed and most other central banks increasingly lean the other way. China started eating more aggressively, blah, blah, blah. All right, so similar stuff. Maybe they'll ease up on the COVID stuff, or they won't even have to, the way the curves are rolling over around the world. China's national team rushes to save stocks after bear market signal. This is their local market, CSI 300. So they've got their kind of plunge protection team out there, and they're telling all their local mutual fund managers to buy stocks, and they're going to do what it takes. Local media reported 7 of China's largest 10 fund management companies, including eFund Management, GF Fund Management, were putting money to work this week. State-owned Securities Times published a story on the front page that blamed domestic institutional investors for the downdrafted onshore listed stocks for their short-term investment outlooks. In case you forgot, you shut down a whole multi-billion-dollar industry with hundreds of thousands of jobs over the summer. Can you blame them for maybe taking a step back and catching their breath for a few months before putting money back to work and trying to guess which industry you were going to shut down next? Well, that said, I guess they've given the green light: buy stocks or we'll kill you. So that's good. We know the first one in. It's like driving in the fast lane in the highway. You always want to be behind the guy in the M5 that's going to get the ticket. So, all right. So, all right, China managers heed state call to invest in stocks after stumble. Win and Sand stock will thrive with Macau overhang fading. Those are ones we've loved for a while, and now they're starting to move, so that's a positive thing. This is by Lawrence Strauss and Barron's. China's personal luxury market grew 36% last year despite COVID-19 challenges. That's good. They can get some of that stuff on Alibaba. And then House's China bill calls for scrutiny of the U.S. investments there. It could be a big deal. This is for Reshma Kapadia. She tends to be very bearish on China, although she wrote a bullish article this week when the stocks were up. Opinion follows trend, but she's worried about this China, the America Competes Act, which would move that timeline in for them to meet the U.S. auditing standards from 2024 to 2023 if it gets passed, number one. And number two, it doesn't matter. We've already transferred our shares to Hong Kong shares anyway. It's just more noise. So that's that. Bank of America actually reiterates the buy on Alibaba. They took their price target down to 203 from 209, but came out with a bullish upgrade. And then Alibaba's stock is attractive. Morningstar upgraded the stock and went into all the reasons why. You can read that at their website. And then Reshma actually had a positive article, which was surprising. She's just been bearish for the last, forever. And she said, watch out for a turnaround in the year of the tiger. And she goes into the easing, and most of the pain is in the rearview mirror in the Goldman Sachs report that we've covered in recent weeks. So it's good to see that. Opinion follows trend. They're starting to bottom, and more and more people will hop on once they're up 20, 30, 40%. Goldman shrugs off rate hikes to bet on emerging market stocks. Emerging market stock valuations, which, by the way, China's 35%. Alibaba is one of the biggest weights. So they're basically saying buy China, which they'd said in their other reports about buying China. But emerging market stock valuations are near their lowest level since 2007 versus U.S. shares. Emerging market economies poised for stronger growth in 2022. And we moved to overweight in emerging markets in November. Looking cheap, good value. Here's the chart that we showed you weeks ago. Emerging market stocks relative to the U.S. cheapest since 2006 and 2007 levels, with growth picking up because they're easing while we're tightening. So that's all positive. Okay, go where the fish are. Stock market and sentiment results. So we went to Key West. This is me with my older daughter, Mimi. This was one of the barracudas we caught, which was pretty awesome. Almost as tall as Mimi. So last week I took the family down to Key West for a little R&R. Since we only had 5 days, I tried to pack in as much activity as possible. Parasailing, jet skiing, snorkeling, dolphins, and deep sea fishing. By far, the most fun for me was deep sea fishing, and it was the most successful outing I've ever experienced. I credit my wife Caitlin for doing the proper due diligence and hiring the best captain on the island to take us out. This was mutton snapper right here, big one. We got that, and these are the two barracudas, and then a bunch of yellowtail snapper, and I forget what that one's called, but we're getting it mounted for Annabelle. She wants to put it in her room, so she takes after Daddy. So this was the mutton snapper before. Then we took it to this awesome seaside cafe, I think. Anyway, it's right on the beach, and they cooked it up for us. And there's like the same amount on the other side of the French fries. You just can't see them. I did it blackened. It was fantastic. This is her catching it. So you see, it's interesting. These fish look actually really small on the pier. Look how small that looks. And then you actually see how large they are. They're enormous. I mean, and look at look at it next to Annabelle. That's our 7-year-old superstar swimmer. And then this is a grouper, which I don't know why we didn't get this one cooked. You can't, certain seasons you're not allowed to. We had to throw that back, and we had to throw the shark back. There are some fish you can't eat because of seasons and different restrictions. By the way, if you're on the podcast, you're going to get cut off in 30 seconds. Go to hedgefundtips.com, scroll down to the VideoCast. You can fast forward the YouTube video to minute 60. You will pick up word for word exactly where you left off, and you can also go back if you wanted to see some of the images and charts we were talking about. You might find that helpful, but that's where you're going to get the rest of it, and we've got probably another 10 minutes of important, very important stuff to cover actually in this article, so you don't want to miss it. Okay, so Captain Billy and his partner Ryan have a reputation for success in getting their clients to catch fish. We heard all morning on his radio in the boat that his peers were having no success from other charter companies, and yet we kept pulling them up. And if you listened to the podcast VideoCast last week, you heard my goal was to catch a shark to mount over our pool. Billy said ours was one of the longest Caribbean reef sharks he had ever seen, 7 to 8 foot range. And he had to send the measurements to the taxidermy company in order for them to create the replica from photos and dimensions. So this is the shark beforehand. And this is after we hooked him. And so why are Billy and Ryan so successful for their clients while their peers flounder for the scraps? Pun intended with the word flounder. Very simple. They know where the fish are, and that's where they go. One thing that was evident was that they did not go where the fishers were. They went where the fish were. You see, Billy was raised in Key West, and his father ran the business before him. He knows the waters like the back of his hand. He goes where other charters don't. In other words, he goes against the crowd for big rewards. Now, hooking a fish is one thing, and reeling it in is another. Reeling in this shark took all the strength I had. I wasn't sure if the pole, the reel, or my forearm would break first, but ultimately we got it reeled in after some time. So how does this apply to markets? In last week's note, we covered that while we were pounding the table on banks and energy in 2020, no one else would touch them with a 10-foot pole. Now that they've all doubled and tripled, everyone else wants them. As such, we've been trimming across the board and harvesting profits. While we still like these groups over the next few years and will hold some and possibly add back on any real weakness, in the short term, it feels exuberant. There are new areas that have more upside in a shorter amount of time at this stage, even if they continue to modestly push higher. When all of the fishers are congregating around one area, it's likely that most of the prize fish have been had for the time being. It's time to pull up anchor and go to where the next group of prize fish are. You have to accept it will be lonely for some time until word gets out on the radio that you're hooking the prizes, just as it was in 2020 with banks and energy. Slowly but surely, more fishers will come to your spot, and the fishing will still be good for some time, as it has been for the last year. But once all the boats have dropped line, it's time to cut bait and move on to the next prime area. So if we know where the fishers are now, where are the fish? The secret to success in this business is to fish where others are not, and then be patient. On Tuesday, I was on Fox Business, the Clayman Countdown with Liz Clayman talking markets and an unloved sector we're leaning into. Thanks to Ellie Terrett and Liz for having me on. Here are my notes. The majority of pain is in the rearview mirror at this point, is what I told Liz on Tuesday. You historically don't get a 20% bear market correction in the S&P without a recession. Recessions are preceded by an inversion of the yield curve, 210 spread. While the curve has been flattening since June of last year, we're nowhere near inverting. A recession is defined as 2 quarters of negative GDP growth. Consecutive quarters. The U.S. is expected to grow at 4% GDP in 2020. Sentiment is washed out. AAII bullish percent hit 21% last week, the lowest since 2020. Bearish percent got up to 46.7%. These levels usually occur near short-term bottoms. VIX hit 38. That was on Monday. It says yesterday because the notes were on Tuesday. Peak fear while backing off. The put call hit 126 on Monday. That was another extreme, meaning people were buying puts for protection at the exact wrong time. The time to buy insurance is before the fire, not after the house is leveled. This level is usually associated with reversals. What the market needs for a tradable bottom. Number one, continued strong earnings from beaten down tech. IBM was a good start on Monday. Microsoft will be critical tonight. Microsoft did great. 2, Federal Reserve back off timing on the balance sheet runoff quantitative tightening. The Fed minutes spooked investors when they spoke of quantitative tightening starting at the first rate hike as soon as March. Market will respond well if it is walked back a bit on Wednesday. Areas of opportunity among the wreckage. Biotech sector down 20% last year. Demand will pick up again as Omicron subsides and doctor visits, procedure script demand recovers, reversion trade. On Wednesday, I emphasized the importance of the Fed backing off on their quantitative tightening rhetoric prior to the press conference. I was on at 2 o'clock, and the press conference was at 2:30. Thanks to Taylor Clothier, Sarah Drammer, Alexis Christophers, Adam Shapiro, and Karina Mitchell for having me on. The additional notes were 4 rate hikes for 2022 are currently priced in and expected. I think we may not get 4, but that's priced in. Anything less than that would be a positive. They're likely to signal the 25 bips for March. They did that. The key to the meeting will be the balance sheet runoff timeline. When the Fed minutes were released on January 5th, it spooked the market. The minutes implied they would start quantitative tightening, reducing the balance sheet as soon as the first rate hike in March. It caused the S&P to decline 12% intraday on Monday, and the NASDAQ declined 18%. Here's when they released the minutes. There's Jay Powell again, just like December of 2018. Market rolls over. Now, if they walk back this error and push off QT for some time, the market will rally. They did walk it back on Wednesday, and now we're seeing some follow through. The other thing that I said in this article, which we'll get to in a second, is that the first move is always the wrong move, and the first move was weakness on the Fed meeting and the next day, and then we got some follow through finally. So if they imply faster quantitative tightening, there will be more pain. Our bet is they will tread carefully this time. To put it in perspective, the last time quantitative tightening began was almost 1.5 years after the first rate hike, which was December of 2015. They started the tightening over a year and a half later. Since all policy loosening and tightening shows up in the real economy 6 to 9 months later on a lag basis, they must be careful not to do too much at once. I really emphasize this on the Yahoo interview. It's worthwhile to check that out. Start with the hikes and see how it goes. Add slow quantitative tightening 6 to 18 months later. And finally, on Tuesday, I joined Rochelle Akufo on CGTN America to discuss Microsoft earnings and the impact of the Activision Blizzard deal moving forward. If you have holdings in either of those, you may find it interesting. Thanks to Ising and Rochelle for having me on. So what's getting crowded? Where are all the fishers, and how do we get to the fish? So just over a week ago, we put out a summary of the Bank of America Global Fund Manager Survey. In last week's note, we pointed out 3 key takeaways. Number 1, net allocation to the tech sector fell 20% month over month to 1%. That's the lowest since December of 2018. You can click on last week's note to see what happened after that point of max pessimism in tech. Let's just say good things happened. Number 2, overweight positions in bank stocks rose to 41% among Bank of America's clients, closing them in on a record set in October 2017. You can see what happened next. They did move up a little bit more, but not a whole lot more, and then they rolled over. So you can check that out. And number 3, net overweight positions in commodities rose to a historical high in January. This is crowded, guys and gals. The last time commodity euphoria was even close was in 2011. So click on the link in last week's note to see what happened to these groups the last time positioning was this extreme. So now we know where all the fishers have run to, banks and energy. We still like these trends over the next few years, but in the short term, too many polls are chasing too few remaining prizes. They have left tech and biotech fisheries empty. That is where we have leaned in over the past week and a half. We are primarily focused on biotech because it was down over 20% last year. Historically, the sector has followed up bad years with record years. For our tech exposure, we are largely concentrated in China tech, i.e. Alibaba. So when I say tech, I'm not talking about high price to sales stocks with no earnings. That's not where we are. Although some of those may start to bounce as well. But we are focused on biotech. Biotech and Alibaba and China tech are our 2 biggest positions. So I don't need to say more. Our money is where our mouth is. Now we got to have patience, but I think these things may actually turn a lot quicker than anyone anticipates, which would be a good thing. So considering there's no one left fishing in these waters, considering there's no one fishing in these waters yet, like Captain Billy and Ryan, we're likely to come up with quite a few prize fish in coming months. Once word gets out on the radio, all the other boats will come. That is some time off, but when the time comes, we'll help out the crowd, take some profits, pull up anchor, and move on to the next set of prize-laden waters. Keep in mind, it's one thing to catch the fish. It's another thing altogether to keep it on the hook as you're trying to reel it in. We've referenced this sentiment chart many times in the past. The bottom part is what it looks like when the fish is trying to get off the line. So, here you are in the boat, you're trying to bring it back up, and while you got it on your hook, man, they are going to go everywhere trying to rip you off. And you'll be panicked, discouragement, wall of worry. You'll think you got it. Then it just swims away from the boat. You're like, oh my gosh, he's going to get away. And then you stick with it. You persist and you get the golden prize. And the other analogy of this under the surface, besides the chaos and the patience you need, look at all this time, it is knowing what you own. It's not, I say we're in an age, I was at lunch with a couple friends. I said, we're in an age where millions of people know the price of everything and the value of nothing. And that's why you see these meme folks getting blown out and going on to sports gambling now that sports are back, is because they haven't done the work. They're trying to get rich too quickly. They haven't done the work to learn what they actually own to determine. The guy who started it, Gil, whatever his name, from Boston, who did the original research on GameStop when it was at $8, had an amazing thesis, and he did amazing work, and he wasn't really trained in that, and he did an incredible job, and he made a ton of money off of it. That is, all the people that piled on later with diamond hands and everything else, they didn't know what they were doing. He did know what he was doing. He actually did his work. So it shows anyone can do it. So it's not a question of being a retail or institutional trader, because he was just a guy up in Boston. I think he was a salesman or a client service guy at a financial services firm, but he wasn't a portfolio manager. He wasn't an analyst, but he did amazing work on that. And anyone can do that, but you got to put in the time. So when the stock does this, which it did with him for a while, I think it went from 8 to 4 to, I don't know. I haven't looked at the chart, but went against him for a while. And like any smart guy that's done it or girl that's done their work, they add more when it gets weak. Once they know what they own, they know what the earnings power is. I personally wouldn't have been involved in that because you were making a bet on a transformation. The earnings were declining. The stores were shutting down. I don't like to do that. I like to bet on businesses that are getting good returns on capital consistently and are out of favor. That for me is more interesting and more predictable, but it was a great thesis. It was a cigar butt thesis, and you can get doubles out of cigar butts. He got more than that because you just caught this kind of viral point in time, and God bless him, and that was great. But he did the work. So while no one was with him, while no one was fishing with him, he was holding on to that fish. He was reeling it in. As it moved against him, he would get more. And then when everyone came on, I'm sure he laid off enough, and he's set. So the Fed. A Bloomberg reporter from Asia reached out after the close for my thoughts on the Fed meeting. Here's what I told him. There was nothing new in the Fed press conference, Fed press release or conference, other than Chair Powell saying the balance sheet runoff would happen sometime after underlying capital rate liftoff. This is a clarification from the Fed minutes in December, which implied they could potentially start simultaneously. The hint of a rate liftoff in March is already priced in. Any uncertainty is now related to the beginning of quantitative tightening. We usually find that the first move is the wrong move when it comes to Fed meetings. I said this right after the Fed meeting, by the way. Today, markets were weak following the conference, and after working through some short-term chop, which it did yesterday, we expect a bid to come back into the market after 3 weeks of constant selling. That bid came in at the close today in a material way. And here's what I also said. Tech was hit the worst, so it may be the first to get bid in the short term. So far, tech earnings have been strong with IBM and Microsoft. Tomorrow's Apple earnings will be the key moving forward, and they were. And Apple earnings were great. So here you go. This is what I said after a few sessions, and boom, tech was top performer, biotech second top performer, Nasdaq third top performer. I also said China tech showed weakness today. We think this is short-lived and represents one of the highest return contrarian plays for 2022. While the developed world tightens in 2022, China will continue easing and set the stage for a nice recovery of beaten down leaders like Alibaba and Tencent. In addition to the Fed statement, the FOMC laid out their, quote, principles for balance sheet reduction. What was new here is that they would wait until after starting rate liftoff to commence QT. In his elaboration, Powell said they would start to talk about it over the next few meetings. This implies a summer start at the earliest. It also means, and this is important, if bottlenecks ease and inflation starts to moderate, it could be pushed back further. This is generally a positive development, and I underlined the key points from their principles on balance sheet reduction. One, they emphasize changes in the target rate for Fed funds rate is our primary means of adjusting the stance on monetary policy. That was unclear in their December minutes. They were debating, should we just use the balance sheet first? Should we do rates? Like, that was never even considered in the past. Like, the idea that they were thinking about using quantitative tightening right away spooked the hell out of the markets. And I reference back to the stupidity because once we got the minutes, thank you, FOMC, this is what happens in the market. So, when you're in those positions, you really have to be careful. Nonetheless, all right. So, committee expects that reducing the size of the Federal Reserve's balance sheet will commence after the process of increasing the target rate. After the process of increasing the target rate range for the federal funds has begun. So that was a key thing. So they did walk it back. They did a good job, and that's why we're starting to see a bid in the beaten down areas, starting with tech, biotech as the top two performers today. Sentiment, again, still washed out, which is good. That creates, you can see it all the way back to 2020. Fear and greed got down into the 30s. That's not, it's not a full extreme. So there could be some more of this, that fish wanting to get off the line and a little chop. But I do think Monday probably the worst was behind us, and I think that will hold true, and we should get a nice follow through here next week. National Association of Active Investment Managers down to 53% equity exposure. That went down a couple points, so they're going to have to get back on, and you saw them panicking into the close, so that's a good thing. My closing from the January 6th note, I just want to say, was pretty solid. I mean, the next Fed meeting is January 25th, 26th. By then, the only Fed data, the data the Fed will have is likely decent jobs report and limited evidence that inflation is rolling over, which we got a little bit today, but not enough. But okay, as I said over our VideoCast last year, when people were looking for big crashes in 2021, I said we were not going to get one. We would be limited to a handful of 3 to 5% pullbacks given all the liquidity. That was true. This changes in 2022. This is what I wrote on January 26th. This is also what I said in December, by the way, many times publicly. I expect to see 8 to 10% mini corrections moving forward. I don't know if we hit 10% on a closing basis, but we got close. If we continue to, well, I said 8 to 10% plus mini corrections moving forward. I don't know if we got 10% on a closing basis, but we definitely got over 8%. And if we continue to gain strength, I'm inclined to harvesting some profits to build up cash going into the Fed meeting, which we did. And we've put a significant amount of that capital, we actually now pretty much all of it, back to work in the biotech sector in the past week. We're going to continue to selectively add in coming weeks. We're fully invested, so we're good. We're good. I mean, would we sell off all of our banks and all of our energy to get more exposure? Maybe, but we want to keep a little bit of that back, even though they'll probably be a little weaker in the short term. But we aggressively leaned in. I mean, we're happy with that position. And then here was the pair selling up 350. I mean, she wanted to do it. I was not. I mean, as high as that looks, it was higher than, I think we were higher than all the others too. I mean, it was pretty crazy, but it was fun. She was happy. That's all that matters. All right, economic data. Couple key points. Manufacturing PMI was a little light. Consumer confidence. Conference board was pretty good on Tuesday. 113 versus 111. What else did we have here? New home sales were better than expected. That was good to see. Up 11.9% month on month. So people are getting fear of loss. Everyone thinks when they raise rates, the housing market's going to crash. It's just the opposite. They started raising rates in 2004. The biggest move in housing was from 2004 to 2007 because people get fear of loss that they're going to get, they're going to miss the boat, and they are. So they got to get off the stick. And with 82 million millennials, they're getting the message, and the affordability is still there. If you look back relative to 2007, rates were 6.25 for a 30-year fixed. Now they're, even if they've gone up to 4 now, And in some of the areas, certainly in the Northeast, prices haven't gone up a whole lot since then. But so there's still opportunity. So that's good to see. That's a backbone to the economy. Continuing claims were kind of in line, a little worse than expected. But the initial, I think, were good. Right in line with expectations. So they were down to 260 from 290. That's good to see, despite Omicron. That's a sign of strength. Core CPE, that's what the Fed looks at for inflation, came in at 4.9. Not great, but it was expected 4.8, so it wasn't some like outlier number. Core PCE price index month on month was at 50 bips, which was in line with expectations, so that's good. Employment cost index. This was the positive inflation note. It came down. It was expected to be up 1.2%, which is effectively labor costs. It was only up 1%. So that was very positive from an inflation standpoint. And that's something we'll keep an eye on. Consumer sentiment was down. It was below expectations at 67.2, 68.7. The minute you see more of these inflation numbers improve, like we saw this morning with the labor cost, employment cost index, if we start to see more of these, like for instance, if there's an Iran deal and oil comes down $15, you're going to see consumer sentiment. Consumer sentiment and inflation are joined at the hip. If inflation's up, sentiment's going to be low, and vice versa. So, because look, inflation, all inflation it's taxation without legislation, and it's effectively a tax on the poor. The people that have to put paycheck to paycheck, have to put gas in their car every day, food for their family. Inflation hurts them, and that's why they got to get it under control. And I think they will as the bottlenecks come in. As now with a lot of these vaccine mandates rolled back, more people are going back to work as Omicron winds down. Because you had 30% or 20% of the population that didn't even have one shot, that didn't want to go to work because they didn't want to take a vaccine. Now everyone else is either vaccinated or boosted or had Omicron. They don't care. So it's off to the races. So that'll bring labor costs down. Also, as Omicron comes down, you're going to see the shift from goods that are on freight carriers sitting outside of LA port, move to services, which have been, there's overcapacity in services now that are going to start to be utilized. People were traveling. It was awesome down in Florida. I think more people want to do that and are going to do that. So the money will go from goods to services. That will also help inflation. Those are the key factors. So we're pretty positive by the summertime when they were going to start the quantitative tightening, those numbers will come down and maybe they'll think twice, delay it, or at least start it on a very slow basis versus being in this panic rush to do everything all at once. And then lastly, earnings estimates, they went up modestly from 223.66 to 223.94. Like to see these move up a little more. They're a little sticky, so we got to keep our eyes on that. And that's it for this week. So I want to thank everyone for listening in. Had a lot to cover. When you have a week or a handful of weeks like that, you got to go into more detail, explain to people what's going on. And I do think the worst is in the rearview mirror in the short term. And I've told you where we're fishing, where no one else is fishing at the moment. It'll be lonely for a while. It'll take a little while. But when it starts to turn, opinion follows trend, and the money will flush back in. And when it flushes back in a major way, we'll help them out and go from there. So look, I want to thank everyone for listening in. I thought the questions were fantastic. We had a lot of questions. Send me your feedback in an email if it's too many Ask Me Anything questions, or if you like the Ask Me Anything questions. By and large, people seem to love the Ask Me Anything questions, so I'll do them all. Otherwise, I can just cut it down to a couple, 2-3 questions a week and play it that way. So send an email to info@hedgefundtips.com. Let me know your feedback on that, and we'll adjust according to your preferences. So with that said, we'll be back next week, same time, same place. We try to do these on Thursday unless I note it otherwise. You can always see at the bottom of the article of the week, I usually say if it's going to be on Friday, I'll specify that. If I don't specify it, it's generally going to be on Thursday. So, but we get them out, and we're grateful for you guys tuning in. In the meantime, have a great week. We'll see you next week, same time, same place. Bye for now.